Welcome and Happy New Year to all of our clients and guests. Of course, my name is Henry Wheelwright, Managing Partner and Co-founder of Stablepoint Partners. This year, we're doing something a little bit different, providing our 2025 outlook as a team in a pre-recorded video. That way you can watch it at your leisure. I have the great opportunity, first and foremost, of thanking all of our clients and guests. 2024 was an amazing year, not just because it was the first year of our full launch of Stablepoint Partners, but also an amazing year for our investors. Strong performance globally in equities, good yields and returns in bonds, an opportunity to incorporate new, unique ideas and alternatives. And let's face it, from 2023 to 2024, we had one of the best bull markets since the early 20s. Global stock markets went up 40%. NASDAQ went up 50% from October of 23 through the end of 2024. And some of the largest new mega cap names, most valuable company in the world, a name like NVIDIA went up an amazing 264%. So it's a new year. How do we get the encore? Well, my job is to talk about some of the themes that Stablepoint Partners has been thinking about, both in portfolios for our existing clients and new relationships that have come on board recently. I think the first for 2025 is not a big surprise. Equities should be strong. We're expecting double-digit returns in the S&P 500, certainly less than the very, very strong 20+% returns in 24. We think volatility will kick up. And I think the United States leads again. And here's the real surprise. Higher valuations are going to be received just fine. I think markets are trading at about 21, 22 times earnings. You're going to hear Chris talk about even weighting and concentration. But I think the leadership may rotate, but it's not going to be a valuation story. It's going to be a bit about inflation, the Fed, tariffs, some things that I'll talk about. But U.S. will lead the rest of the world outside of India. I think the UK, broader Europe has some challenges. Certainly China has some challenges. So U.S. equities are where we want to focus. Second theme is AI spending, and the AI craze is going to be bigger, but perhaps a shorter cycle. Initially, we were anticipating about $4 trillion of spending, had almost $300 billion of AI spending by U.S. companies alone last year. 2031 was supposed to be our peak out, according to some of our research partners. I think AI and the focus on spending for profitability and margin expansion is going to be really important and be in focus. What I'm saying is a lot of spending is out there. CEOs feel the pressure to talk AI, have a strategy. As we get further into 2025 and certainly into 2026, it's going to be where are the returns on that investment. I don't think it's the hyperscalers that have led the AI boom that are going to be the best performing stocks. Our team is thinking about mid, small size companies that are involved. Some may be consolidated. Valuations are a lot less. And again, I look back to the internet days. AOL as an example came to market, really allowed us to have internet searches, but it took Google to come in, really dominate the market, monetize the market through advertising. AI is going to have to go through that cycle. Got to talk tariffs. Of course, it's coming. Trump will be in office here shortly. Short term, I think Trump tariffs will happen. The bark may be bigger than the bite, is my view. China is going to be in focus first. There's been discussions alone today, early January, in China to talk about Taiwan, something that I'll mention shortly. I think the first year you'll see some volatility around tariffs, predominantly focused on China and Mexico, and some unease in the market. To be honest, I think that's probably our bigger risk to short-term volatility. As we get through the back half of the year and certainly into 2026, I think you're going to see a much more relaxed approach, and the market will really enjoy that. I think that's a bullish catalyst once we get through those initial policies and know the facts around tariffs. I want to talk about geopolitics. Obviously, it's a challenging world. I don't think it's about Ukraine and Russia. I don't think it's about necessarily the Middle East. I think the biggest risk right now to markets the next few years is the relationship between China and Taiwan. Taiwan clearly plays a significant role in the semiconductor production. It would be a major, major challenge to the U.S. economy and consumption if there was disruption there. And I think that's part of the bark by Donald Trump is going to be bigger than the actual bite with China. We need a solid relationship with China. We need to intervene and make sure that from a geopolitical standpoint, action with China and Taiwan doesn't happen. M&A activity. We've already seen financials report earnings. Financials have come out of the gate with very, very strong returns. Part of the new administration is going to be rolling back regulation. That should favor what everybody's talking about, financials and energy. What's the surprise there? I think you're going to see some real consolidation. I don't know the names. I don't want to talk about specific stocks, but there's going to be some large cap companies looking to acquire mid-sized companies to help drive growth that they can't get organically. U.S. economy is going to be solid this year, but the big surprise is you're going to see some household names merge, get acquired. You'll have names actually be taken private. Probably my biggest example is some of the news that's been going around potentially with Walgreens and their challenges of taking that company and going private. Expect 2025 to have some surprises. M&A helps, financials, energy, but big names are going to get consolidated this year. I want to talk about data centers. Nuclear is not going anywhere. You're going to continue to see what we saw in 2024, investments from Amazon, Microsoft, right? Meta. If you are going to power this next move in AI, you need 24-hour power, 365 days a year, and it's just not going to happen from traditional power sources. And this is a global challenge. So expect more and more discussions. Utilities could play very well, not just the big ones that have already rallied. That's going to be a focal point the next 4 years. I think this administration is going to be favoring that. Tax cuts. I see gridlock. A lot of talk by the Trump administration about rolling back some tax cuts. We've had interest rates, something that Chris and Claire will talk about, rise to 14 months highs. The cost of servicing our deficit is significant. I don't think we go anywhere there. A little bit of a disappointment for those that thought that would be a catalyst for boosting economic activity or boosting markets higher. I think even with a Republican Congress, things get gridlocked. Where's the value in the market? PE multiples are high. I started saying the U.S. can deal with those valuations. I still expect double-digit returns in equities. If I were to look at some of the value-oriented sectors right now, I think there was an over sell-off with Robert Kennedy Jr. and his relationship and nomination from Donald Trump. A lot of pharmaceutical healthcare companies are trading at 10 or below PEs. There's a lot of innovation and growth, which is a wonderful thing for the world happening in that space. I think healthcare is a real sleeper. If you're looking under rocks where there might be great deals in a largely fairly valued or expensive market, healthcare looks really interesting. And of course, energy, which has come out of the gate very, very strong in the month of January, also looks like a sector that should be a bit cheaper. Where's the next bull market coming if it's not technology? Housing and industrials, right? We know this last election, there was a lot of discussion about inflation, housing, immigration. We've had really an undersupply of housing for the population growth the last 10 years in the US. I think the next 2 years, particularly when we look at political mandates, you're going to see a real move to continue to develop and tighten up some of that shortage in housing. If we're going to continue to have a solid U.S. economy, we're going to have another leg of a bull market that's not led by tech. Housing's the big surprise. I think, lastly, media and sports keeps getting bigger. Netflix in the NFL. We had a Tyson fight that drawed over 140 million users. WWE wrestling has come to Netflix. We now have TGA Golf with Rory McIlroy and Tiger Woods behind that as we start to think about different ways to monetize that. What's behind the scenes? Gaming. Las Vegas Sands, DraftKings, FanDuel. It's a perfect marriage of monetizing whether we feel comfortable with the moral side of that. Gaming, gambling, media, sports, drive margins, free cash flows, look for some M&A activity potentially there, and look for those areas like housing, gaming to be sleepers where you can get above average returns. Chris is going to talk about the specifics on our views on equities and fixed income, but just remember, every year has a few twists and turns. I think the surprises are going to not be what's every day. It's going to be an opportunity to think differently, and that's what Stablepoint Partners is here to do. We appreciate your confidence. I'll pass it along to Chris.
Thank you, Henry, for that. That was really helpful on the big picture outlook of everything that we're seeing here at Stablepoint and with our partners at Goldman Sachs on the economy, what's happening globally, and a lot of the big picture stuff that'll really help to frame our thesis and how we want to invest capital in the year, and the years ahead. So for today's outlook, I've been tasked with speaking more specifically on stocks, bonds, and alternatives, really the three big asset classes in the market that are going to make up our allocations with you as our client for the years ahead. So I want to spend a moment and just kind of talk through our thought processes there on each asset class, especially in light of a lot of the bigger picture backdrop that Henry just provided. So let me start with the stock market. I think that's where we spend a lot of our time. It's certainly what makes the headlines and grabs our attention when the news comes on. That's front and center all the time. So we've had a wonderful year in the market, right? The S&P 500 in 2024, and a lot of enthusiasm, I think, for the years ahead. But I want to spend a minute and really talk through some of the inner workings of the market. And although we had a big year in the market index, the S&P 500, it really came from a very short list of more speculative tech-focused companies that have become now a larger percentage of the whole than we've really ever seen in the history of our country, as far as the percentage of the market consolidated in these 10 largest companies in the United States. So this has happened before a couple of times. We do have some historical precedent to look back on. And oftentimes when you see this peak in concentration amongst the top 10 companies, it does at some point coincide with at least a short term peak in the markets, and probably the beginning of a little bit of a rotation in the markets where money will start to come out of those high flyers of yesterday and really into the themes that are prevalent for tomorrow and moving forward. So in the market, given this very, very high point in the Magnificent Seven and these top 10 names, we've seen a real disconnect. And I'll share a chart with you here that just takes a look at the price to earnings ratio of the Magnificent Seven versus the S&P 500 as a whole, of which they're a big part of. And the specific chart I should show the other 493 stocks relative to the seven. And you can really see the disconnect here. And the higher the price to earnings ratio, the lower the earnings yield, right, that we're getting. If you take the P divided by the E and flip that over, you do get that earnings yield. So a price to earnings ratio of 30 is an earnings yield of about 3.3% versus a price to earnings ratio of 19, which is a little bit over 5%. Needless to say, there's a big disconnect here between the Magnificent Seven and the rest of the market. They're trading at very high valuations, both relative to the rest of the businesses today, but also by historical standards that typically sees a price to earnings ratio a good 10 points higher. So we do see some issues there with the market, particularly around the concentration in those top 10 and the much higher price to earnings ratios and valuations that we're seeing. Although looking backwards, they're warranted. That's been where the earnings growth has come and the revenue growth has come, is a lot to do with AI, with chips, and around the technology sector looking in the rearview mirror. However, with that said, looking forward, we do expect in 2025 very much a reversion to the mean of where earnings growth is going to come from. And we expect those other 493 companies to really get back to contributing and becoming a little bit more neutral relative to those Magnificent Seven. And that makes us think, well, as markets start to revert back to the normal, could we be entering into a 2000 to 2010 era? For those of you that were investors through that period of time, as we were, that came to be known as the lost decade in the stock market. I'm sharing another chart with you now that talks a little bit about that decade. That was one of only two 10-year periods of time in our country's history where stock market returns were negative for the decade. In this particular instance, you can see the blue line of the S&P 500. The market was negative about 1% per year over the course of 10 years. So if you did the math, if you had $1 million in the S&P 500 at the beginning, a decade later, you had $913,000, so loss of about $100,000 over 10 years. Had you taken the same 500 companies in the S&P 500 and simply evenly weighted them, no academic research, no sector picking or stock picking or analysts, you would have had a 5.1% rate of return. That's that orange line that says S&P 500 equally weighted. And when you compound that difference over 10 years, your $1 million grows to $1,650,000. So compared to the $900,000 in the index, should we be in a period like this ahead? And we're not saying that we are, but we want to be prepared for it. Evenly weighting an investment portfolio, whatever you own, whether it is the Magnificent Seven or the S&P 500 or dividend paying stocks or you name it, we really think it's more critical now than really at any point in the last 25 years, especially for those that are thinking about their rate of return, but also the risk that they have in front of them. Keep your portfolios evenly weighted, rebalance, take some profits from yesterday's winners, refocus on some of the underperformers from last year and where they may be going moving forward. This will really help protect us in case this environment does come up. With that said, we are cautiously optimistic about the market. The Goldman Sachs analyst team has a 6,500 year-end price target for the S&P 500, implying about a 10% upside from where we're at today. But within the market, again, look to rebalance, look to be evenly weighted with whatever your approach may be, because everyone's different. And when we looked at, as a team, we do meet regularly looking at the portfolios, looking at the metrics. The opportunity set really does start to be looking a lot more attractive now for value stocks or dividend paying stocks. That dividend aristocrats thesis looks more attractive now relative to the growth stocks of the Magnificent Seven than it has at any point here in the last few years. So again, cautiously optimistic on the stock market. We're overdue for a correction, not worried about it. We'll get through it if and when that does come up. But let's make sure that we keep a healthy amount of prudence with how we invest in stocks, know what we own, stay evenly balanced, and rebalance a couple times a year. So moving on from the stock market to an area that we don't spend nearly enough time on, and that's the bond market. The bond market's been a really interesting place to be the last 4 months. Now, on September 18th, when the Federal Reserve started cutting interest rates, we've actually seen longer term rates like the 10-year Treasury start going up, actually the opposite direction at the same time. The Federal Reserve has cut rates by a percentage point, and the 10-year U.S. Treasury has gone up by a percentage point during that same period of time. So what really grabs me is that the relationship between the overnight federal funds rate and the longer term 10-year Treasury, the dynamic there has changed by 2 full percentage points as short-term rates have come down and long-term rates have come up. And just to give you some numbers going back to September, the Fed funds rates were in the 5.25% to 5.5% range, and the 10-year Treasury was at 3.65. That's unhealthy. That's what we call an inverted yield curve, where short-term rates are higher than long-term rates. It gives you really no incentive to invest, no incentive to lock your money up. Savings accounts, money markets get very attractive. So now you're looking at something much closer to parity and a much more healthy yield curve, with the federal funds rate 4.25% to 4.5%, and the 10-year Treasury today at 4.6. So you actually do have what's called a term premium. So you're getting paid a premium, more interest, by locking your money up for some term of time. And I'm using a 10-year Treasury as an example because it's a great barometer for the bond market. So we feel like the bond market is much healthier now. And I'm going to share another chart with you here. I know Claire is going to get into the Fed and Fed policy here later in this session. But as you take a look at the chart that's on your screen now, you'll see a whole bunch of colorful dots. And what you're looking at here is the starting yield to start a year of the 10-year U.S. Treasury bond and what its rate of return was, over the next 5 years. So you'll see the 2010s, right, certainly stand out as a pretty miserable time. As we all remember, to be a bond investor, you started off with very, very low yields, and you had fairly miserable rates of return in the bond market, versus eras like the 1980s when you had incredibly high interest rates and bond returns were double digits through that decade. Today, we're kind of in the middle, right? At the end of 2024, yields were closer to 5% on the 10-year Treasury, and that implies a 5-year rate of return for the bond index of just over 5%. There are other parts of the bond market, however, that could offer more attractive yields, lower rated investment grade bonds, high yield bonds, preferred stocks, and things of that nature that I think you want to have in a bond portfolio for diversity, but also to maximize yields and get the best rates of return we can with managing risk to the best of our capability as well. So our outlook on the bond market is as good as it's been. We're starting at a higher yield today, and our outlook is still for some potential Federal Reserve rate cuts over the rest of 2025. So for more conservative investors, those managing risk, looking for income, I really do like the bond market here over the next couple of years. And lastly, I'll close out on that big bucket that we call alternatives, right? Alternatives, and it's a label that I hate. Wall Street needs to do a better job, I think. But alternatives are just really anything that's not a stock or bond. So real estate, any private assets, private equity, private credit, infrastructure, precious metals like gold and silver, you name it, they all fall into that alternative. So for a lot of clients, one of your core alternatives areas may be something like physical gold. And that's had a wonderful run. I think last I looked, that was up 26% in the past year. Great run and great hedge against inflation, but definitely part of that alternatives bucket. But I'm sharing a chart with you here now that's talking about the various buckets of the alternatives market spot and how that compares to a 60-40 traditional stock bond portfolio, both from risk as well as correlation, meaning do they ebb and flow and generate their rates of return at the same time, or maybe in a little bit different timing for some risk reduction. The bubbles that you see, the size of the bubble represents the yield that you get. The bigger the bubble, the bigger the yield. And the bottom of the chart is the correlation to that 60-40 portfolio. So the further to the right you are, the more in line you are with a regular balanced portfolio of stocks and bonds. And the more to the left, the more you're kind of acting on your own and the better a diversifier you are to that 60-40. And on the left side of the chart is your 10-year average investment return over the last 10 years. So the higher, the better. In light blue, you'll see a variety of real estate assets. Above that, in dark blue, you'll see transportation and infrastructure assets. And in purple, you'll see other private assets like direct lending, otherwise known as private credit, and above that, private equity. So this is an area you've probably started to hear a little bit about from myself and the rest of the team here at Stablepoint. We are planning on, and a lot more information to follow, coming out with our own customized alternatives vehicles, probably May to June of this year that we're really excited about. But we do see a lot of these asset classes, from real estate to infrastructure to private credit to private equity to others, as having a good opportunity, I think, not just in 2025, but over the next 3, 5, and 10 years ahead to diversify your portfolio. So your peaks and valleys, that's that correlation, are better, right? Not as big of a peak, not as big of a valley, more steady. Hopefully, we can generate more income for those clients in retirement. Those cash flows can be very helpful, but also potentially, seek out some better rates of return. And historically, we have seen that from some of those areas in the alternative space, particularly around infrastructure and private equity. So those are much more of a one-on-one conversation with myself, Henry, Claire, Kenan, and really how those tie into your own portfolio. But outside of stocks and bonds, I think the utilization and the incorporation of other asset classes moving forward is going to be helpful if it's done correctly and it's done in the right parts of your portfolio for tax efficiency. So with that said, kind of putting a bow on the specific asset classes of stocks, bonds, and alternatives, we are definitely cautiously optimistic on the road ahead. We see good things ahead for the stock market, albeit a little overdue for that regular correction. We see good things ahead for bonds now that we're starting off at a pretty healthy and normal interest rate cycle. And we see opportunities outside of stocks and bonds to both diversify and pursue other opportunities. So with that, I'm going to pass it over to Claire Smith, who's going to talk a little bit on Fed policy, on updates to tax and financial planning items that are coming up here in 2025. I'll be up again at the end just to say goodbye.
Hi there, and happy 2025. Claire Smith here, Vice President and Financial Advisor at Stablepoint. I'm going to take a few minutes to discuss policy from the Federal Reserve and then tax policy items on the horizon as well. So let's start at where we've been. In the back half of 2024, the Federal Reserve reduced the Fed funds rate by 75 basis points from about 5.25% to around 4.5%. This was implemented in response to cooling inflation and a cooling labor market last year. And also during this time, and despite these cuts, we actually saw the 10-year Treasury yield, which is correlated to our longer term bonds, think mortgage rates, go up about a percentage points. So why would this happen? And it's really a combination of factors, which is also shaping Fed policy for 2025. And these include, first off, inflationary pressures from potential tariffs from the new administration, expectations of an expanding federal deficit from additional spending, as well as tax cuts, a strong economy really marked by a tight labor market that we're seeing, and then lastly, higher overall global rates outside of the US. So these are our market headwinds, meaning they could lead to difficulty and volatility in investment markets. And that's why looking into 2025, the Fed finds itself taking a wait and see approach. So, in quantitative terms, this involves the likelihood of a slower path of rate cuts, and the expectation is of about 2 to 3 cuts this calendar year. But the overwhelming consensus is that the Fed is prioritizing getting back to a neutral state. So, the Fed in 2024 was center stage with markets reacting to every adjective that Chair Powell used. But this year, it's really going to be, economic growth, corporate earnings, and the political and regulatory landscape that's going to be in focus. And as Chris discussed outlook on various asset classes and Henry, the macro landscape, 2025 is shaping up to look like the new old normal for total return in portfolios. So breaking that down a little bit, this is really meaning the TINA, or the there is no alternative to stocks approach as far as performance goes the last few years is going to be taking a back seat, we think. What was the old normal before this cycle? This involved attractive yields, tight spreads, and positive yield curves. So in thinking about the best approach to the policy uncertainty ahead, this includes, an active, diversified, and income-producing portfolios that have really defined risk-based asset allocation in past cycles. So let's pivot and talk about other policies impacting 2025 and future planning, namely tax policy from the new administration, something that we're definitely all paying attention to. So first off, the Tax Cuts and Jobs Act provisions were set to expire after this year, or are right now. The expectations are for a full extension of this. So this would include keeping the higher lifetime estate tax exemption, also the slight reductions to most individual income tax rates, and then more significantly to corporate tax rates. However, the very unpopular SALT deduction cap is also at the forefront. This is the state and local tax deduction for those that itemize their taxes. It was capped at $10,000. There is an indication of a raising or possible elimination of this cap, which would really greatly benefit those who are in our high tax paying states. And then a final note on potential tax cuts include income taxes on tips and Social Security, the latter being the one that affects many clients. And this would have a direct impact on the net monthly payments to your bank accounts for those who are Social Security age. So overall, we have got a lot that we're watching, but of course, sticking to our tried and true approach of staying the course and focusing really on the things that we can control in your financial plan. Thank you very much.
Hi, everyone. Today I'm going to talk about a topic that is very exciting and really the core of our practice here at Stablepoint, and that is financial planning. When we think about financial planning, it's really not a one-time thing, and that's because there are constantly changes being made in our lives, whether those are changes in our personal life, changes in the market, changes in laws, like tax laws, for example. All these changes can impact our plan. Regular reviews will help us make sure your plan still aligns with your goals and that you're overall staying on track. Without these check-ins, you may miss an opportunity to adjust your plan or really take advantage of something new. I'm here to work with you every step of the way. And whether it's developing the plan or reviewing it regularly, we're in this together. We'll look at your income, tax situation, estate planning, insurance, you name it. And we'll make sure that we're staying proactive. We don't just want to make updates because I really want you to understand why we're doing what we're doing. And my goal is to make sure that you're always confident in your plan and the decisions that we're making. If you want to dive deeper into any of these, I'm always available for Zoom meetings, come into the office. I'm happy to meet with you one-on-one and can even bring in Henry, Chris, or Claire just to make sure that we address everything. These meetings are a great way to get personalized advice tailored to your situation. So let's schedule a review. Reach out to me. We can dive into those areas mentioned, or really more importantly, whatever's most important to you now. I'm here to make sure your plan stays on track and continues working for you. Thanks for watching this, and I'm really passionate about helping you with your financial journey, and I'm confident that these planning reviews will be valuable. Don't hesitate to reach out. I'm here to help, and I really look forward to working with you.
Well, Henry, Claire, Kenan, thank you all so much for everything that you put together for our 2025 Outlook piece here for everybody. And for those of you that took the opportunity to watch and listen to everything that we had to say, thank you for doing that as well. I hope you had a good bucket of popcorn and were able to find a good time to sit through our comments and hopefully like this format of a pre-recorded session so you can watch it at your convenience as opposed to what we've always done over the years, scheduled at a specific time. So with that said, again, just wanted to say thank you from myself and everybody here at Stablepoint. Your trust and your confidence in us, it truly means the world to us. We're really looking forward to our regular review meetings in 2025 ahead, as we've done for years, and really getting back on track and in that rhythm and in that cadence and having those deeper discussions on everything that's going on for you. We have, as you know, an additional resource now with Kenan as another CFP who's working with myself, with Henry, with Claire, and a great person there to do a quick update to any financial plans, relook at retirement cash flows. So feel free to take us up on that as well if you just want to punch through some updates there and take a look at some things. He can work with us on creating some of those analyses and working together. But other than that, thank you again for taking the time, for being here with us today, for your trust, your confidence, your advocacy in us as your advisors. And we truly look forward to a great 2025 ahead and many years to follow. And would encourage you at any point, reach out to us individually, as you know, with any questions that you have, or to set up some time to get together and chat through really anything that's on your mind. Thank you, and all our best for a fantastic 2025.